Hello and welcome to Module 6 of the Forex Complete Solution Intermediate Trading course on the further study of global economic indicators. Global economic indicators generally refer to economic variables that may determine global economic direction over a period of time, reflecting the movement of the global economy as a whole. For a comprehensive record of all of this data, go to www.tradingeconomics.com, and I will show you that website now. Here we have it. It's www.tradingeconomics.com. And this website will give you up-to-date figures that you will need to prepare yourself for a forthcoming fundamental data release. You will be able to have a look at the historical data of all the main global economic indicators. Okay, so we're going to start discussing the two types of global economic indicator. There are two types of indicator that you will need to be aware of: leading indicators and lagging indicators. A leading indicator is a measurable economic factor that changes before the economy starts to follow a particular trend. Leading indicators are used to predict changes in the economy. A lagging indicator is a measurable economic factor that changes after the economy has already begun to follow a particular trend. Okay, lagging indicators confirm long-term trends, but they do not predict them. I will now look at the top leading indicators that you will need to familiarize yourself with. Okay, so fiscal policymakers and governments use leading indicators to forecast where an economy is headed and use them to implement or alter fiscal programs. So we're going to start looking at the leading economic indicators, and there's a full list of all the indicators. Okay, so on this website you will have every single global economic indicator that you will need. I'm going to give you a breakdown of the ones you're going to be looking at, the main ones you're going to be looking at, and how they affect the market that you will be trading. Okay, so again, these are the leading indicators. I'll begin with the stock market. Stock markets are based on what companies are expected to earn. So an economy can get an indication of direction of earning estimates. And if these are accurate, then an economy can get a gauge of whether the stock market is in a bullish or a bearish mood. Okay, so whether you're looking to trade equities, such as the Dow Jones in America, the DAX in Europe, the Hang Seng or the Nikkei, okay, you want to look at the main economy and how the overall picture of the economy, okay, and the overall strength, okay, and here's where your global economic indicators will help you. Okay, so the next one we're going to look at is manufacturing activity. Okay, so manufacturing activity influences the gross domestic product strongly. An increase in GDP suggests a stronger demand for consumer goods, leading to a stronger economy. An increase in manufacturing activity also leads to an increase in employment, which is also a boost for an economy. When looking at manufacturing activity, confirm the figures with retail sales data. Okay, if manufacturing activity and retail sales are on the rise, then it shows a healthy demand for consumer goods. Okay, so you can see your business here, manufacturing. Okay, so you can pull down manufacturing, and no matter what country you are trading in or whatever market you're looking at, you have a record of the manufacturing activity. So the main figures you're going to be looking at are going to be the previous figure. Okay, so if you're waiting on a data release, you want to look at the previous figure. Okay, and you will also have an expected figure, and that will be shown on your economic calendar. Okay, so once you have those two figures and the market releases the data, you can get a direction. Okay, so was the figure higher than the previous, or was it lower than the previous? Okay, you don't need to go too in depth. Just familiarize yourself with what these indicators are. And then you need to look at their figures. And if their figures over the last quarter or the last 6 months or the last year, are they increasing or are they decreasing? And here you can get all your historical data. Okay, and you're looking for a news release, you go to your economic calendar. So the economic calendar here is going to give you the time and the dates when these news releases are happening. So this changes on a daily basis. So there's Tuesday the 7th of July 2015. These are your news releases today. So whatever market you're trading, you need to be aware of when these events are happening, and it's all there for you. Okay, you can see all the different news events and how they are going to impact your market. Okay, so we just go on to our next leading indicator, which is retail sales. So strong retail sales directly increase gross domestic product, which in turn strengthens the home currency. Increased sales lead to companies to hire more employees to manufacture and sell more goods. This in turn increases consumer spending. Generally, an increase in retail sales gives an indication that the economy is improving. Okay, so you're looking for retail sales. So you can go down to your consumer, and here are your retail sales for the various countries. So again, this website, no matter where you are trading or what market you're trading, all your data is here. Okay, and we also have a very good tool over here to your right. Okay, you can pick a country, and we'll pick the United States. Okay, everybody knows the United States. Okay, and you just calculate, and there's a huge amount of data on the US economy. Okay, all there for you on one page. You've got your GDP figures, you've got your unemployment rates. Okay, scroll all the way down, and you have a historical record of all those figures. Okay, and that is going to be part of your trading plan. So that was your retail. Okay. The next leading indicator is the housing market. Okay, a housing market in decline can reveal that the supply exceeds demand, or that existing prices are unaffordable and that housing prices are inflated and may need to correct as a result of a housing bubble. Declines in housing prices have several key negative impacts on an economy: a decrease in homeowner wealth, a reduction in construction employment, a reduction in property taxes. And the two main data points to look for when looking at housing data are the changes in housing values and the change in sales. A decline in sales generally indicates a drop in values also. Okay, and where you get your housing data, you just come down to housing, and you have your housing data for the various different countries. Okay, so the main markets, again, it doesn't matter whatever market you're looking to trade, as I keep saying, it's all your information is here. So if you're not trading the main markets such as the United States, China, Japan, Germany, but it doesn't matter, all your information is here. So no matter what currency pair you are looking to trade, you can have a look at all the economic indicators here, and that will give you a basis to place your trade. Okay. So small business sentiment. Okay, new businesses entering an economy is another indicator of economic health. Small businesses can contribute significantly to gross domestic product as they introduce innovative ideas and products that will stimulate growth. Okay, so that's your small business indicators. So you can go down to business, and there you have your small business sentiment. Okay, and you have all your various prices. Okay, your last prices and the high prices, everything's there for you. And again, if you're looking for when these are going to come out, you go to your calendar, and there you have it. Okay, you can see what information is coming out on a certain day. Okay, so there you go. Now we go back. So that was the main leading indicators. Okay, now lagging indicators. Okay, lagging indicators will not tell us where the economy is headed, but they will indicate how an economy changes over time and can help identify long-term trends. Okay, and one of the main global economic indicators in whatever country you're looking to trade is the gross domestic product. Okay, so I'll begin with the gross domestic product, or GDP. GDP is considered by economists to be the most important measure of an economy's current health. An increase in GDP is a sign of a strong economy. Gross domestic product is the monetary value of all the finished goods and services produced within a country's borders in a specific time period. It includes all of the private and public consumption, government outlays, investments and exports, less imports that occur within a defined territory. A rule of GDP is that when GDP drops for 2 quarters, then a country is technically in a recession. So that's your GDP, and here we go. There's all your GDP data for you. Okay, and all you have to do is click back to see the current rates of GDP. The next lagging indicator is income and wages. Labour wages. Income and wages. So in an efficient economy, earnings should increase regularly to keep up with the average cost of living. A decline in wages is an indicator that employers are either cutting rates of pay or laying off employees. And incomes are broken down by various demographics such as age, gender and education. And we can go down to our labour, and we can see our employment and our wages. Okay, so there's your wage information here, and there you have it. So our wages on the increase, or are they on the decrease? Okay, what does this affect? It affects consumer spending. It affects retail sales. Okay, so this is going to give you an indication of the strength or weakness of an economy. Okay, and that is a lagging indicator. There was the income and wages. And our next one is the unemployment rate. So the unemployment rate measures the number of people looking for work as a percentage of the total labour force. A healthy economy will have an unemployment rate between 3 to 5%. A high unemployment rate leads to consumers having less money to spend, which will impact negatively on the GDP, housing markets and retail sales. So as you can see, none of this is too complicated. It's a lot of it is common sense. If employment rate is down, people will have less money in their pocket. That will affect retail, that will affect consumers. Okay, and that will affect manufacturing and so on. So a GDP figure will be down. So you're constantly looking forward in the market and how that will impact, where if employment figures are going up, it's going to create more jobs creates more wealth creates more retail sales, and consumers will buy more, etc., etc. So these figures do impact how an economy will react. So just to be aware, none of this stuff is too complicated. You might see the screen there and you've got a whole batch of global economic indicators. The main thing is to know the figures, okay? Know are they increasing or decreasing, and know the reasons why. So our next lagging indicator is the Consumer Price Index. The Consumer Price Index reflects the increased cost of living, or inflation. Consumer Price Index measures the cost of essential goods and services, including vehicles, medical care, transport and clothing. Inflation is then seen by the average increased cost of the total basket of goods over a period of time. And a higher rate of inflation may erode the value of a currency quicker than the consumer's income can keep up. Okay, and this can lead to a decrease in purchasing power. So inflation can affect job growth and lead to a decrease in employment and GDP. Okay, now deflation occurs when consumers cut back on spending and is often caused by a reduction in the money supply. So retailers will lower prices to meet lower demand. As retailers lower prices, profits then contract, which can lead to higher levels of deflation. Okay, so you can see how this stuff goes hand in hand. Okay, our next lagging global economic indicator is interest rates. So interest rates represent the cost of borrowing money. These rates change as the result of economic and market events. When a central bank increases its rates, then banks and other lenders have to pay higher interest rates to obtain money. In turn, the banks and lenders lend money to borrowers at higher rates to compensate for this. This can discourage borrowers to take out loans. This can affect businesses from expanding and consumers from taking out debt. Okay, as a result, GDP can stagnate. Interest rates are indicative of an economy's current condition and can offer further indication of where it may be headed. An example would be the US Federal Reserve looking to raise interest rates. They can do this because economic indicators such as wages and employment are improving. Hence, the economy is gaining strength. So as you can see, the central banks, i.e. in America, the Federal Reserve, are looking at economic indicators for themselves so they can look to raise or cut interest rates. And at the moment, they're looking to raise interest rates. And they're looking to do that because the US economy looks like it's gaining strength. And how do we see this? Well, we see a rise in employment, we see a rise in wages, we see retail figures. So this is how economies work and how central banks make decisions. They're looking at these global economic indicators. The next lagging indicator we will look at is the balance of trade. Okay, the balance of trade is the difference between exports and imports and indicates whether a country has a trade surplus, i.e. more money coming into a country, or a trade deficit, i.e. more money leaving a country. When a country has a trade surplus, it has control over the majority of its own currency. This causes a reduction of risk for another nation selling this currency, which causes a drop in its value. When a currency loses value, it makes it more expensive to purchase imports. An example of how a trade deficit can affect a currency is the United States trade deficit. Large amounts of US dollar are being held by foreign nations, which may decide to sell at any time. A large increase in dollar sales can drive down the value of the currency, making it more costly to purchase imports. Okay, so that can have an effect on the trade surplus. Okay, so in summary, global economic indicators work best with your technical indicators, i.e. using your intermarket analysis. You're going to be using your fundamental and technical analysis together to make better trading decisions. So whatever security you're looking to trade, be aware of how a fundamental news event will impact your position. If the US dollar is it's rising at the moment, and so if you're looking at the US dollar rising, what you're also going to be looking at as a news event would be data releases from the Federal Reserve, and they'll be talking about interest rates. Okay, if you're looking to trade the Euro USD, you're going to be looking at the ECB, or the European Central Bank, for their news events. Okay, so always look back to your economic calendar to gain this information. So we can get our economic calendar on various websites. You have your economic calendar on tradingeconomics.com, or else you can go back to your investing.com. It's the same calendar, just to show you that different websites are useful for different things. Okay, the economic calendar here today will be exactly the same as the one on the previous website there. So you just bring up your time zone and London time, and here we have it. Okay, so there's all your data releases for today. As you can see, they're the same data releases. So if you're looking to trade a Euro USD, you're going to be looking at a Euro group meeting today. Okay, and that's going to have an impact on your position. So if you need to know what time that is or what date it's on, there you go. Okay, and that you'll know in advance whether you're going to take a trade at that time or whether you're going to stay out of the market. Okay, so along with your global economic indicators, and just again, you can get this information on other websites, but www.tradingeconomics.com, it's quite concise. Okay, most of your information is there. You also have your economic calendar, covers pretty much every country. All your indicators are there. Okay, whatever you're looking to view, it's all there, and it covers currency, stocks, bonds, commodities. It covers them all. Okay, so again, just to show you, if you're looking at a GDP price, so you want to look at the previous price and what the expected price is going to be, and how they match up. Okay, and then you can take your trade. So just to be aware of these prices. For instance, an interest rate rise is it's not going to happen every month or every couple of months. It's a unique event. So if a central bank does raise an interest rate or cut an interest rate, it's going to have a big impact on the currency pair you're looking to trade. Okay, so if the ECB are making a interest rate announcement, just be aware of how that will impact your trade. Is the Euro USD going to buy on that information, or is it going to sell on that information? Okay, if you're trading equity, is the ECB's decision of quantitative easing, for instance, is that going to create a market that is going to be bullish or bearish? Okay, so take all of these factors into play. So again, this is why you want to educate yourself and take a step-by-step process to trading. Again, we've covered our technicals, we've covered our fundamentals, and now we've done a further study of the global economic indicators. And again, you're not going to be able to study every single indicator and be an expert on every single thing. So keep it simple, okay? Just be aware of the current and previous prices, and be aware of how they're going to impact on your trade, okay? So again, all that information is there, and we've covered it in most of the modules. And in the advanced course, we'll be going further on how to plan your trade. Okay, so how to have a detailed trading plan from start to finish, an A to Z trading plan. So no matter what you're looking to trade, you have all your angles covered. You have 5 or 6 or even 7 reasons of why you're looking to take a trade. And whether you're looking to be a day trader and scalp, or whether you're looking to position trade and take a longer term trade, or if you're looking to trade in equity, for instance, and take a 3 to 6 month position, it will cover all your bases. Okay, so again, no matter what market you're trading or what time scale you're trading, you're going to be looking at the same news events, okay? Because the markets all move together. So no matter what you're trading, you need to take a good long view at the markets and a broad view of the markets to see how each market is going to react to what you're looking to trade, okay? So thank you for taking the time to listen to our module on the further study of global economic indicators, and I hope you will enjoy our next module, which will be a summary of the intermediate trading course. So thank you very much, and goodbye.